What's up everybody, GenExDividendInvestor here. For those of you that are new to my channel, feel free to watch some of my other videos where I review my $1 million dividend portfolio that I've built up over 25 years of investing in the markets. In this video I'm going to analyze the subscriber's dividend portfolio that was sent to me and who asked for my feedback. Then I'm going to follow Tinder's lead and swipe right if I like the portfolio or left if I dislike it. Then I'm going to share two real-life neat stories about the power of dividend investing that were told to me earlier this week on my free Dividend Discord chat server. I'll also answer a question I'm asked a lot, which is what I do now for a job. By the way, these videos take a lot of time and energy for me to plan, research, and create, so I'd appreciate if you took a moment to jump on that thumbs up button as a simple way you can thank me. And as a quick caveat, I'm not a professional wealth manager, so as always, don't take anything I say as financial advice you should follow. Additionally, I'll run a poll in the community tab on my YouTube channel so that you can vote on if you like or dislike this portfolio. That way we can see how the whole community feels about this portfolio rather than just me. In my last portfolio review, I swiped the portfolio to the right and then 271 people in the community voted. 66% agreed with me that they liked it, so I aligned to the majority viewers' opinion. And as I said last time, I'm just some random dude on the internet who's passionate about dividend investing, but that doesn't mean you need to agree with me. Just because I might like or dislike a company or a portfolio does not mean it's a good or bad company for you to own. It's just my perspective of what I like, and I obviously don't know every detail about your finances and goals and risk tolerances and such. So just take this as entertainment. But now let's go check out this hot little sassy portfolio that was sent to me. Here's the email I got from a subscriber named Pablo. He said, "Hi, I posted a comment on YouTube this morning as I would like to participate in the subscriber portfolio Tinder series. I tried other ways to send you my portfolio and I think that this is the best way. I hope it suits you. I am 18 years old, living in Scotland and investing with Trading 212. I just started around 1 month ago with £885, which is around $1,050, and investing £125, which is $150 a week, still holding some cash in case of another downturn. Long life dollar cost average. Of course, I'm still learning about investing in my companies, so I keep changing the allocation or even the companies I own. About the goal of this portfolio is super long term. I want to create a stream of income over the years, and hopefully this can allow me to cover all my expenses and beyond at some point. Thank you so much. Keep up the awesome work. By the way, I gave you a copy of my spreadsheet, so if you want to delete or change anything to make it easier to see in the video, it's completely fine." So he included a link to his awesome spreadsheet. Thanks, Pablo. First, I want to say you are awesome for investing at 18. Keep it up during good times and bad times, and I can almost promise you that your future self will someday look back and be so grateful that you started investing in quality companies and kept with it. Try to avoid spending money on crap that you don't really need. I wasted a lot of money in my 20s on cars and girls and partying. I wish I'd spent less money on the cars, but the girls and the partying were worth it. And how cool is it that you're living in Scotland? I'm so jealous. My school mascot at Carnegie Mellon was a Scottish Terrier sporting the tartan plaid, so I figure I'm pretty much Scottish too. Okay, let's look over each of your positions, then look at your portfolio overall. First, you have 4 financial companies. Aflac is a great insurance company, though they have been killed lately by interest rates and treasuries that have fallen through the floor. But they have something like 38 years of consecutive dividend increases, so I hope their streak continues. Then you have 3 of the big 5 Canadian banks, including Royal Bank, Toronto-Dominion, and Bank of Nova Scotia, also known as Scotiabank. Those banks are all amongst the top 100 world's largest, so solid plays. Financials take up around 13% of your portfolio, and your largest position in this sector is only 6% of your portfolio, so a nice spread. Looks like you have set a desired target weight for each sector and you're almost at your goal of 13%. Awesome job planning ahead and nudging your portfolio in a direction. Then we come to technology. I often feel dividend investors are making the mistake of not owning the best tech companies like Microsoft, which I own, as well as Apple, another I own, because their dividends are too low. But I see that you hold them, so that's awesome. In this sector, Apple is your largest position at around 3% of your portfolio, and then you have Microsoft at 2.5%, and then 2 more solid companies in Intel and Cisco. That being said, I would consider making tech a heavier portion of your overall portfolio. You're around at 8%, and I'd consider 20 to 30%. You have all solid name brand companies though. Then we come to energy, and you have 2 solid companies which I also own, Chevron and Exxon. In aggregate, they're only about 1.7% of your portfolio, so congratulations for not chasing yield, yet still having a bit of exposure. Then we come to utilities, a sector I like. We see you have Dominion, which is a great utility, Con Ed, which is another solid one I used to own, Atmos, which is strong, and Nextera, also great. So awesome job going with quality. Then we come to your consumer sector, which we can tell visually is where you hold most stocks. First you have Coke, which I own, and is a dividend investor favorite. Then you have Pepsi, another one I own and another favorite, and one which I feel has better financials and growth potential than Coke, even though I personally prefer the Coke drink over Pepsi. Then you have GPC, aka Genuine Parts Company, an automotive parts company, another solid company which is one of the 29 or 30 dividend kings out there, so very exclusive. Then you have another dividend king in Hormel Foods, another I like a lot and a favorite of an old CEO I used to work with. And then you have Leggett & Platt, a great company I own, and you have two more awesome companies I also own in Home Depot and then Procter & Gamble. Super solid, and this sector is around 12% of your portfolio. Then we hit industrials, and a quick scan tells me they are all solid companies. Your two biggest positions are Caterpillar, which I own, and 3M, another I own. Those two represent about 11% of your portfolio. Then you follow those two up with General Dynamics, which is an aristocrat, and Waste Management, one which I'll bet will become an aristocrat, so all very strong companies. Kudos. Then we come to healthcare, which is about 11% of your portfolio. You have everybody's favorite and one I own in Johnson & Johnson at 5% of your portfolio, and then Pfizer at 2%, and then you finish it up with Merck & Co. at almost 4%. Awesome. Then we come to another sector that dividend investors often love, which is REITs. First is Realty Income, aka the monthly dividend company that everyone loves, and which I hope can make it through this pandemic relatively unscathed. And then we come to Federal Realty Investment Trust. They have an incredible 52 years of consecutive dividend growth if memory serves, but they are in shopping centers, which gives me some pause. Rewind to before the e-commerce explosion, and I love this one, but I wonder if my great-grandchildren would like it. That being said, Devil's Advocate says that malls can be around for a long time because people love that tangible and tactile aspect of going to a mall, trying things on, and shopping. So tough call. Looks like you have around $2,500 in your portfolio, which is a great start, and your portfolio's average weighted yield is 3.9%, which is nice and conservative. You have 32 positions. I can handle that. Over 30 and I start wondering if you will have enough time to track each of your companies, but lots of people have more than that and manage just fine. You have 9 sectors covered, which is good. I don't see materials, which is fine. It's only about 2% of VU anyways. And it looks like you combine consumer staples and consumer discretionary into one sector, which is also fine to do. I often like to tweak my sectors and industries to fit what I feel makes sense. I like the fact that you don't hold any bonds. It surprises me when I find people in their 20s holding bonds. You're at an age where you want to be more aggressive, not less. Yes, bonds can save you the downside, but over the long run I believe equities will far outperform bonds. I'd personally tell my kids to never get into bonds and just stick with quality equities and then be prepared for more volatility. But you gotta have the stomach for that ride, especially as you get closer to retirement. One thought I have is I'd love to see some strong non-dividend stocks like Google, Amazon, and Facebook, all of which I'm long in. Tech is actually my largest sector by far in my overall stock assets across my dividend portfolio and my growth portfolio, and is also the sector I understand the most, so no coincidence there. I like how your largest position, which is Realty Income, is only around 9% of your portfolio, which aligns to my personal guidelines of trying to keep each individual position under 10%. That being said, lately with the market run-up, both my Apple and Microsoft positions have crested over 10%, but that's why it's a guideline and not a rule for me. So what do I think overall? I'm thinking whiner, diner, dripper, flipper, and if she was single, get engaged. I love your portfolio and I'm swiping right. So what do you guys on the interweb think? Vote in my community tab if you would swipe right and smash with this portfolio, or if you would swipe left if you'd rather go play Pinochle with your Aunt Sally. What the hell is Pinochle anyways? I think if you keep investing for 40 years, it wouldn't surprise me if you end at $1 or $2 million. Obviously, I don't know if you'll get that high, but if the broad trends continue and you consistently invest a good amount in quality companies, there's no reason why you can't get up there and beyond. So dude, you are kicking ass and you built a great portfolio. Investing at 18? Are you kidding me? Damn, I'm proud of you, man. Okay, now I'm going to tell you 2 stories I heard on my Discord this past week that I think you'll enjoy. Then I'll tell you about what I do in real life for work. I normally would tell you who told me these stories, but I was asked not to share names. So the first story is about a guy on my Discord server whose dad worked for Emerson Electric, aka EMR. Emerson is an American multinational Fortune 500 company that manufactures products and provides engineering services for a wide range of industrial, commercial, and consumer markets. They have 76,000 employees in 205 manufacturing locations worldwide. They have a $37 billion market cap and are a dividend king with 62 consecutive years of dividend growth. So back to the story. In 1980, when this subscriber was 2 years old, his dad gave him 8 shares of EMR stock into a custodial taxable account with the DRIP on. A custodial account is a brokerage account that you open for a minor, and you retain control of it until they are 18, at which point you lose control and they gain control. A normal custodial account is a taxable account, which means you owe taxes on your dividends as well as when you sell and have capital gains. His dad didn't do a custodial IRA because his son didn't have any earned income, which is one of the requirements. Nor did he do a custodial Roth because, number one, they didn't exist in 1980. In fact, the Roth didn't come into existence until 1997. And number two, his son wasn't making income. However, if he could have done a tax-sheltered custodial for his son because his son was making some sort of income, then he could have avoided paying taxes on that drip income over the years. I recommend you all look for creative and legal ways to minimize your taxes. How can a 2-year-old make income? Well, perhaps he models kids' clothing. Or maybe he stars in a YouTube channel about kids who review toys. Trust me, there are a lot of ways for your kids to make real income. Fast forward from 1982 to 2020, and this subscriber is now 42, and his 8 shares of EMR have turned into around 230 shares, worth $14,400, even though he didn't buy any additional shares. Let's look back and see how much his dad invested and how they grew so much. So looking at their share price history, it looks like his dad bought around $24 worth in 1980 because each share was $3 and he got 8 shares. Let's see how much money $24 is in today's money. So looking at an inflation-adjusted calculator, $24 back then is like $75 today. So a relatively small amount of money, but still a very nice thing to do for his son, and probably at the time he didn't have much money. Now let's see what happened to EMR over that time. Let's take a look at StockSplitHistory.com to see if EMR has some stock splits, which could help explain the share increase. We see that since 1980 they split multiple times. In 1987 they did a 3-for-1 split, which means for each share he had before the split, after the split he had 3. So since he started with 8 shares, he ended at 24 shares. Then in 1997 they split 2-for-1, so he went from 24 shares to 48 shares. And then in 2006 they did another 2-for-1 split, so he went from 48 shares to 96 shares. So if he hadn't dripped anything, his 8 shares would have turned into 96 shares just from splits. But his dad turned the drip on when he bought them, so instead of having 96 shares in 2020, this guy has around 228 shares, which means that over his 40-ish years, his drip alone bought him about 132 shares. So that relatively meager $75 investment of 8 shares of EMR in 1980 turned into around 228 shares of EMR worth $14,000 today. That is 187x growth. And that is the power of compounding in time. Quick calculation shows me EMR had a good dividend CAGR of about 7% over that time frame, but in the last 10 years it was lowered to 4%, and in the last 5 it was only 2%. So they're definitely slowing down. Now, one thing that is important to understand is that this account he set up for his son was a taxable one, which means that some of his returns were eaten up each year in taxes he paid on the income the dividend dripped. So always factor in tax implications. Still a pretty cool story of how a trivial amount of money turned into a nice chunk of change. Gandhi once said, "Live as if you were to die tomorrow, learn as if you were to live forever." I think that's an awesome quote, but I'd like to add a slight tweak to it. Plan and learn like you will live forever, live like you will die tomorrow. Planning and acting also has compounding aspects to them. Planting a fruit tree today will give you fruit and shade decades down the road. The same is true for investing. Little actions you plan for and do now will have compounded effects down the road. Okay, now for another quick story. This one also came from someone on my Discord. In my video called Why You Shouldn't Buy Stocks, I've said that it's never too late to invest. Well, today I heard a great example highlighting my point. This subscriber told me that when his dad was in his 40s, his net worth was less than 0, which means he had more debts than he had assets. But his dad started investing in dividends and bonds and mutual funds and such. And now, decades later, his dad's net worth is 7 figures and is now making more income than the year he retired from working. Outstanding, and something for everyone to realize they can achieve if they start planning and acting now. Okay, a question I'm asked frequently is, what do I do for a job these days? Well, right now I spend my working hours in a startup that I'm a partial owner in. I get a small amount of cash for my time, but my real compensation comes from an increasing percent ownership stake in the company. It's risky because 95% of startups fail, but if it makes it, then it might do well. So that's my normal 9-to-5 gig. Beyond that, I put an inordinate amount of hours on my YouTube channel and on my Dividend Discord server, as well as my other social media platforms, because I find it incredibly fun. For those that are unaware, I run the world's largest free Dividend Discord chat server. And the last time I checked, we had over 3,450 Dividend investors on it, and it's growing all the time. Let me tell you, we have built up a cool community of investing friends on my server, and many of us chat with one another every day, so it's been neat to find other people who are into dividend investing. We also have a bunch of people who just lurk rather than participate, and that's fine to do as well. Which reminds me, I'd like to do a quick shout out to my latest Patreon champion, King 2020. He's part of the medical community and has been sharing some fascinating details about COVID, so I really appreciate him being part of the server as well as supporting me. Thank you so much for watching all the way to the end. Please consider liking my video and I'll chat with you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.